Rental income trap. 3 mistakes that trigger a CRA audit in 2026. There's something happening right now that most Canadian landlords aren't talking about yet, but it's already begun. Across the country, the Canada Revenue Agency has quietly intensified its focus on rental income reporting. And what we're seeing in 2026 is not business as usual. 3 specific mistakes that thousands of Canadians are making right now, without realizing it, are triggering CRA audits at rates we haven't seen in years. This isn't about deliberate tax evasion. This is about everyday landlords, retirees supplementing their CPP and OAS with rental income, middle-class Canadians trying to build retirement security making errors they don't even know are red flags. And the consequences? They're significant. My name is Joseph, and today we need to talk about what's changing, why it's happening now, and most importantly, what you need to do to protect yourself. Let me start with what's been happening behind the scenes. Over the past 18 months, the CRA has been deploying advanced data matching technology. They're cross-referencing provincial land registry records, mortgage interest deductions, property tax filings, and rental income declarations with unprecedented precision. This isn't speculation. Tax professionals across Canada have been reporting a sharp increase in audit notifications specifically targeting rental property owners. The Canadian Taxpayers Federation noted last year that compliance reviews related to real estate income were up significantly, and that trend has continued into 2026. Why now? There are several converging factors. First, government revenue pressures. Canada is facing mounting deficits, rising debt servicing costs, and the enormous fiscal burden of an aging population. CPP and OAS expenditures are climbing every year as baby boomers retire in record numbers. The government needs revenue, and closing the tax gap, the difference between what's owed and what's collected, has become a priority. Second, the housing crisis has put rental properties under intense political scrutiny. There's public pressure to ensure that landlords are paying their fair share, particularly as housing affordability dominates national conversations. Third, technology has caught up. The CRA now has tools that can flag inconsistencies automatically. What used to require manual review can now be detected algorithmically within seconds. And here's what matters. These aren't just corporate landlords being targeted. The majority of rental property owners in Canada are individuals, retirees renting out a basement apartment, working Canadians with a second property, families who inherited a home and decided to rent it out instead of selling. These are the people now finding themselves in the CRA's crosshairs, not because they're trying to cheat the system, but because they're making mistakes they don't realize are serious violations. So what exactly are these 3 mistakes? Let me be very clear about this, because understanding these errors could save you thousands of dollars and months of stress. Mistake number 1. Underreporting rental income. This is the most common trigger, and it's happening in ways that surprise people. The CRA expects you to report every dollar of rental income you receive. That includes cash payments, e-transfers, rent paid by family members, even partial rent or cost-sharing arrangements. Here's where people get into trouble. They think that because they're only renting to a family member at below-market rates, or because they're receiving cash that isn't going through a bank account, or because the tenant is covering utilities directly, that somehow this income doesn't need to be fully reported. Wrong. The CRA's position is absolute. All rental income must be declared. And in 2026, they have the data to prove what you received. How? Tenant rent receipts for tax credits, utility company records showing multiple names at one address, bank deposits that don't align with declared income, property tax records indicating a multi-unit dwelling but only partial rental income reported. The system is cross-referencing everything. And when there's a mismatch, when the CRA's data suggests you should have received more rental income than you declared, you get flagged. And that flag often leads directly to an audit. Mistake number 2. claiming personal expenses as rental deductions. The second major mistake involves expense deductions. Canadian tax law allows landlords to deduct legitimate expenses related to earning rental income. Mortgage interest, property taxes, insurance, maintenance, repairs, these are all potentially deductible. But the line between personal use and rental use is where people are getting caught. Let me give you a real example. You own a property with a basement apartment that you rent out. You claim 50% of your home insurance as a rental expense. But the basement apartment is actually only 30% of the home's square footage. The CRA will notice this, and they'll reassess. Or consider this scenario. You rent out a vacation property for 8 months of the year, but use it personally for 4 months. You claim 100% of the annual property tax and insurance as rental expenses. That's a mistake. You can only claim the portion that relates to the rental period and rental use. What we're seeing in 2026 is the CRA scrutinizing these calculations with forensic precision. They're requesting floor plans, utility bills, rental agreements, photographs, anything to verify that your claimed expenses are accurate and proportional. And here's the critical part. If they find you've been overclaiming expenses, they don't just deny the deductions. They reassess multiple years. They charge interest on the underpaid tax, and in serious cases, they assess penalties for gross negligence. Mistake number 3, failing to report capital gains on property disposition. The third mistake is perhaps the most financially devastating. When you sell a rental property, you're required to report the capital gain, the difference between what you paid for it and what you sold it for, with adjustments for improvements and selling costs. Many Canadians understand this in theory, but in practice, we're seeing 2 specific errors that are triggering audits. First, claiming the principal residence exemption when you're not entitled to it. The principal residence exemption allows you to sell your primary home without paying capital gains tax. But if you've been renting out part or all of that property, you may not qualify for the full exemption or any exemption at all. The CRA is now systematically reviewing property sales and cross-referencing them against historical rental income declarations. If you reported rental income from a property for 5 years and then claimed a full principal residence exemption when you sold it, you will be audited. Second, underreporting the actual sale price or overstating the adjusted cost base. Some taxpayers attempt to reduce their capital gain by inflating renovation costs without proper receipts, or by claiming personal expenses as capital improvements. Others misunderstand what qualifies as a capital improvement versus a repair. In 2026, the CRA is requesting detailed documentation for any claimed adjustments, and if you can't provide receipts, contracts, and proof of payment, they'll deny the claims and reassess your tax accordingly. So who exactly is being caught in this trap? The answer might surprise you, because it's not who you'd expect. Yes, professional landlords with multiple properties are being audited, but the majority of people facing CRA scrutiny are everyday Canadians, retirees who are supplementing their CPP and OAS payments with income from a rental property. These are seniors who bought a second home years ago, maybe a cottage or an investment property, and are now relying on that rental income to cover rising costs of living. For these Canadians, an audit isn't just stressful, it can be financially catastrophic. Many are on fixed incomes. They don't have the cash reserves to pay reassessed taxes, interest, and penalties. And if their rental income has been helping them stay above the GIS income threshold, a reassessment could affect their benefits eligibility. We're also seeing working Canadians affected, people in their 40s and 50s who are trying to build retirement security through real estate. They're renting out a basement apartment to help cover their mortgage. They're holding onto a starter home as a rental while living in a larger property. These aren't wealthy investors. These are middle-class families trying to get ahead. And a single mistake on their tax return can unravel years of careful planning. Then there are Canadians who inherited property and decided to rent it out rather than sell. They're often the least sophisticated landlords with the least understanding of tax rules, and they're making errors simply because they don't know better. Finally, there are near retirees, Canadians in their late 50s and early 60s, who are counting on rental income to bridge the gap until they can access CPP and OAS at 65 or 70. For this group, an audit that results in significant tax liabilities can delay retirement or force difficult decisions about selling assets at the wrong time. Let's talk about the actual financial impact, because this is where the stakes become very real. Imagine you're a retiree receiving $1,800 per month in rental income from a basement apartment. That's $21,600 per year, significant money for someone on a fixed income. Now imagine you've been claiming 50% of your home's expenses as rental deductions, but the CRA determines that only 30% is appropriate based on square footage. Over 3 years, that difference could result in $15,000 to $20,000 in reassessed income. The tax on that reassessed amount, at a marginal rate of 30%, would be approximately $4,500 to $6,000. Add compound daily interest going back 3 years, currently calculated at prescribed rates set by the CRA, and you're looking at another $800 to $1,200. And if the CRA determines that your error was due to negligence or willful blindness, they can assess a penalty of up to 50% of the understated tax. That could add another $2,250 to $3,000. Total cost, potentially $7,500 to $10,000 or more. For a retiree on a fixed income, that's devastating. But it gets worse. If you've been supplementing your income with unreported rental income and the CRA reassesses you, your total reported income for those years increases. And if you were receiving the Guaranteed Income Supplement, which has strict income thresholds, you could be found to have been ineligible. The CRA can claw back GIS payments retroactively. For someone who was receiving $900 per month in GIS, that could mean repaying $10,800 per year, multiplied by however many years are reassessed. We're talking about 5-figure liabilities that can wipe out retirement savings. And here's what many Canadians don't realize. The CRA can go back further than 3 years if they suspect gross negligence or fraud. In extreme cases, there's no time limit. For those who sold a rental property and failed to properly report the capital gain, the numbers are even larger. A property purchased for $300,000 and sold for $600,000 has a $300,000 capital gain. With the current inclusion rate, you're taxed on a portion of that gain. At a marginal tax rate of 40%, you could owe $60,000 or more. If you tried to claim the principal residence exemption improperly, or if you underreported the sale price, and the CRA catches it, you're not just paying the tax. You're paying interest from the date it was due. You're potentially facing penalties. And you're dealing with months of back and forth with the CRA while your financial life is in limbo. So why is this happening now? What's driving the CRA's increased focus on rental income? The answer lies in fiscal reality and political pressure. Canada's federal deficit has been a persistent concern. Debt servicing costs are consuming an increasingly large portion of the federal budget. At the same time, spending on senior benefits, CPP, OAS, GIS, is rising as the population ages. The government needs revenue. And rather than raising taxes broadly, which is politically difficult, they're focusing on compliance and enforcement. The logic is simple. Close the tax gap, collect what's already owed, and you can generate billions without changing tax rates. The CRA has publicly stated that improving compliance in the real estate sector is a priority. They've received additional funding in recent budgets specifically to enhance their audit capabilities and technology infrastructure. There's also a political dimension. Housing affordability is a defining issue in Canada right now. There's public frustration with landlords, particularly in markets like Toronto and Vancouver where rents have skyrocketed. Ensuring that landlords pay their fair share resonates with voters. And from a technical standpoint, The CRA now has tools that make this type of enforcement practical: data sharing agreements with provinces, access to financial institution records under certain circumstances, and advanced analytics platforms mean that identifying discrepancies is easier than ever. This isn't a temporary crackdown. This is the new normal. The CRA has made it clear that they view the rental income sector as a significant source of unreported tax revenue, and they're investing in the infrastructure to identify and pursue that revenue systematically. For Canadian landlords, the message is unambiguous. The era of lax enforcement is over. Tax professionals across Canada have been sounding the alarm. Chartered professional accountants are reporting that they're seeing more rental income audits than at any point in the last decade. Many are advising their clients to voluntarily disclose past errors before the CRA finds them, using the Voluntary Disclosures Program to minimize penalties. Pension and retirement experts are particularly concerned about the impact on seniors. Organizations that advocate for retirees have noted that many older Canadians are unsophisticated taxpayers. They may have been filing their own returns for years without professional help, unaware that they're making mistakes. The Canadian Federation of Independent Business, while primarily focused on small business, has also commented on the compliance burden. They've noted that many small landlords operate as sole proprietors and are struggling to keep up with increasingly complex tax requirements. Real estate lawyers are advising clients to maintain meticulous records: every receipt, every rental agreement, every communication with tenants. The standard advice now is, document everything, because you may need to prove it. Provincial housing advocacy groups have had mixed reactions. Some argue that ensuring tax compliance among landlords is appropriate and necessary. Others worry that aggressive audits could push small landlords out of the market, reducing rental supply at a time when it's desperately needed. What's clear is that this is a developing situation. The full scope of the CRA's enforcement push won't be apparent for months or even years. But the early indicators suggest that this is significant, sustained, and carefully targeted. So what should you do if you're a landlord or if you're earning rental income in any form? First, review your past tax returns immediately. Go back at least 3 years. Look at every rental income figure you reported. Ask yourself, is this accurate? Did I report everything? Did I include cash payments, payments from family members, any informal arrangements? If you find errors, don't ignore them. The CRA's Voluntary Disclosures Program allows you to come forward and correct mistakes before you're audited. If your disclosure is accepted, you'll have to pay the tax and interest, but penalties can be waived or reduced. This is critical. Voluntary disclosure only works if you do it before the CRA contacts you. Once you're under audit, it's too late. Second, verify your expense deductions. Calculate the actual percentage of your property that's used for rental purposes. Measure the square footage. Review your claimed expenses and make sure they're proportional and legitimate. If you've been claiming personal expenses as rental deductions, even unknowingly, stop immediately and consider amending past returns. Third, keep detailed, organized records going forward. Every receipt, every bank statement showing rental deposits, every rental agreement, every invoice for repairs or maintenance, every communication about rent increases or tenant issues. Store these documents digitally and physically. Assume that you'll need to produce them on demand. Fourth, understand the principal residence exemption rules. If you've rented out part of your home, or if you've converted your principal residence into a rental property at any point, consult with a tax professional before you sell. The rules are complex, and the stakes are high. Do not assume you're entitled to the full exemption. Do not guess. Get professional advice. Fifth, if you're planning to sell a rental property, calculate your capital gain accurately and report it fully. Keep records of your original purchase price, all capital improvements, and selling costs. Only claim adjustments you can document with receipts. And finally, consider hiring a professional. If your rental income is a significant part of your retirement plan, if you're supplementing CPP and OAS with rental revenue, if you're managing multiple properties, this is not the time to file your own taxes. A qualified accountant who specializes in real estate taxation can ensure compliance, maximize legitimate deductions, and protect you from the exact mistakes that trigger audits. The cost of professional help is far less than the cost of an audit. Looking ahead, what can we expect? All signs point to continued and intensified CRA scrutiny of rental income. The government's fiscal pressures aren't going away. The aging population means CPP and OAS costs will keep rising. Deficits remain a concern, and housing affordability will remain a political priority for the foreseeable future. Technologically, the CRA's capabilities will only improve. As data sharing agreements expand and analytics tools become more sophisticated, the ability to identify discrepancies automatically will increase. We may also see regulatory changes. There have been discussions in tax policy circles about requiring landlords to file additional forms or provide more detailed breakdowns of rental income and expenses. While nothing has been announced, it's a possibility. For Canadian seniors and retirees, this has direct implications for retirement security. If you're relying on rental income to maintain your standard of living, you need to ensure that income is reported correctly and that you're not at risk of a reassessment that could trigger GIS clawbacks or other benefit reductions. If you're planning to sell a rental property to fund retirement, you need to understand the tax consequences in advance and plan accordingly. The era of informal rental arrangements, casual record keeping, and assuming the CRA won't notice, that era is over. The new reality is one of transparency, documentation, and strict compliance. Canadians who adapt to this reality will be fine. Those who don't are taking a significant financial risk. Let me bring this together. The CRA's focus on rental income in 2026 is real, it's systematic, and it's affecting thousands of Canadians who never thought they'd be audited. 3 mistakes: underreporting income, overclaiming expenses, and mishandling capital gains are triggering audits that can result in significant financial consequences. For retirees depending on rental income to supplement CPP and OAS, for working Canadians building retirement security through real estate, for families managing inherited properties, the stakes are high. But this is not a reason to panic. This is a reason to take action. Review your past returns. Verify your deductions. Keep meticulous records. Understand the rules around principal residence exemptions and capital gains. And get professional help if you need it. The tax system expects accuracy. The CRA now has the tools to verify it, and the cost of mistakes has never been higher. Stay informed, stay compliant, and protect your retirement security by making sure you're doing things right. If this information was helpful, subscribe to this channel for more analysis of Canadian pension policy, government benefits, and retirement planning. Share this video with anyone you know who earns rental income or who's planning for retirement with real estate, and leave a comment below. Let me know if you have questions, if you've experienced a CRA audit, or if there are other topics you want me to cover. My name is Joseph. Thank you for watching, and I'll see you in the next one.